Hello there, everyone. Today's video is going to be me running through a few terms and words and abbreviations that I believe natural resource investors, particularly in the junior natural resource space, need to know. To start with, a very commonly used abbreviation is NPV. NPV stands for net present value. Think the money which a project will be made discounted to the percentage given in the NPV each year. Note that not all NPVs are created equal, as some use 5%, some use 8%, and some 10, some 7, and there's plenty of different numbers. But with an NPV 5%, if the cash flow in year 1 is 100 million and in year 2 is 100 million also, then if the NPV started at year 1, it would be 195 million because of the 5% discount the second year. Now, remember that different resources in different parts of the world should be discounted differently because of jurisdictions and different things. And although this is commonly used term amongst many mining companies, almost all the percentages given, whether it's 5 or 8, are probably too low. Why is that? Well, because simply the cost of capital for these companies is higher than those numbers. The next term is IRR, which stands for initial rate of return. And to understand this, you have to think about what percentage of the what percentage return will the company get on the money that they need to put the project into production. So this is critical to look at to see if the project is economic or not, because a company will probably require around 20% before it's a good project that will definitely go into production at that level and is protected a bit from the downside in the commodity price. Now, some could go into production at like 15, 17%, but really, I like to see above 20. Next term is 43101. This is basically a code that's given to resource estimate reports. When a company wants to officially state or estimate its resource size, it requires one of these reports. The next most detailed type of report is a PEA, or Preliminary Economic Assessment. This is an official report where the company, or via a third party normally, tries to determine what the economics of the project are. Now, bear in mind, this is very initial, very preliminary, as it's in its name, and doesn't know what the final costs are. It's still an estimate. So there are often significant changes between a PEA and the next few terms that I'm going into, but a preliminary economic assessment is just that. There's going to be changes, and they use resources that they're not completely certain are and will require more drilling for more certainty. After a PEA is done, the company can then work towards a PFS, which is a preliminary feasibility study. And it's the next step towards being able to bring a mine to life. Now, it is a more advanced plan than the prior estimate, and it has more factors in the economics. Maybe there could be some refining from the PEA stage, and this is mainly to have an idea if the project can actually work. From PFS, the company can then advance the project to DFS, or Definitive Feasibility Study. Think you can take this one to the bank. This is more extensive. It requires a lot more work, a lot more people, a lot more engineers to figure out exactly how this project will go into production and what the more problems could be and how things will be resolved. Is it perfect? No, oddly. And if you want to, if you want money from the bank to help finance the project, you're going to need a definitive feasibility study most of the time. The next term to be aware of is dilution. Mining is a very capital intensive business. So from exploration to the resource estimate to the PEA, PFS, DFS, and keeping the lights on along the way, there's more money needed constantly. Now, what this does, because the company doesn't know if it'll ever be able to monetize the asset, it finances this through equity, meaning it issues shares for money, and thus it dilutes the ownership of its assets, hence the word dilution. It normally does this via private placement. Private placements are a common form which companies can issue shares to accredited investors. There are a few variants in this, including flow-through and issuing with warrants, but the idea is they offer shares plus a bonus for the people that are adding fresh money into the project. The warrants, as we'll get into a second, are that bonus. A warrant is a right to purchase a share of the company at X price for the next Y amount of time. It's similar to an option, and the price is normally above the share price, so it's more of a if the company can be successful and prove the thesis, then the people who gave money for the shares will also get to exercise their warrant, giving more money to the company, but being rewarded in share price and extra shares. Warrants can come in a variety of time frames. The next family of terms, which is still part of the dilution theme, is rollback, consolidation, or reverse split. Sometimes a company will issue shares and then continue and issue more shares and get to a point where there are too many shares to adequately reflect changes in the company's value, where 1.1 cent change would be a bigger change than the company's intrinsic change in worth. So these being the same thing, will take a certain number of old shares of the company and turn it into a smaller number of new shares of the company. So if you had 500 shares of the company that had 1 billion shares, you might have 1 share of the new company, which is worth the same thing, and the company would have 200 million shares. This doesn't really change anything, but allows the company to trade more precisely. And when it happens, normally the shares in the company, the price gets sold off after. Not always, but normally. Next in the family of terms, we have reserves. Reserves come in 2 forms, proven and probable. They're the resources in a deposit that a company is most certain actually exist. In final definitive feasibility studies, they only include proven and probable resources, or we'll get to it next, measured, but it's basically the most certain, the most proven or probable resources. Next is resources. Resources are resources that a company believes it has, but is less certain than reserves. Now, this could mean that they've had less extensive drilling, or that they are less sure about the system, but these are often used in preliminary economic assessments. They include titles measured and indicated or inferred. So from most certain to least certain, it's proven, probable, measured, indicated, then inferred. So there's a whole wide range with slight variations, but think of it this way. Initially, they're inferred, then it goes as they go through the economics and get more and more certain, the resources kind of escalate through the thing, normally requiring drilling along the way. As for costs, you've probably seen the term AISC. Now this stands for all-in sustaining costs, but note they are not all costs, even though they call it all-in sustaining costs. It's close, but it's think bottom line, think costs in an almost bottom line matter. It includes many factors, but again, not all. So if you're really looking for a cost structure, it's normally slightly higher than what the all-in sustaining cost seems to measure, but it gives you a good idea of about what you're looking at. You've probably also seen G&A. This is gross and administrative, and think basically the costs that go into running a company, the management and all the being public costs and filings and stuff like that. Some more terms that have to do with the density of the resource are grade, which is literally the concentration of the resource, G-T, which stands for grams per ton, or alternatively ppm, which stands for parts per million. Note that 10,000 ppm is 1%. MLBS, which stands for million pounds, and cutoff grade, which is resources only includes basically the resources in the cutoff grade are only resources above a certain density of resource in the deposit. Ones below it aren't counted because even if the ore is mined, they might not be extracted. Some more terms associated with later stage project development are MOU, which stands for Memorandum of Understanding, and EIA, which is Environmental Impact Assessment. These are late stage things that need to be often done in order to bringing the resources to market and get the last of the permitting. So that's it. I hope this helps. I know I didn't perfectly discuss everything. I wanted to give an idea, but I didn't want to go in deep. And so the veterans in the space may see this and say I'm not explaining things properly. It's possible, but I'm trying to break it down very simply. I hope I didn't forget too much, and I hope you all enjoyed. And so until next time, I hope that if there's any questions or comments, you'll let me know below. I read them all. But that's it for today. Hope you enjoyed. Until next time. Hey everyone, just quickly, you can read this here or in the description of any video. Just remember, what I do and say here is meant to be a helpful supplement or thought filter for your research, not a replacement for it. I can be wrong, and I'm often quite early, aka wrong for a good while, which is why none of this is ever investment advice.